None of the concerns that we attributed to the drop have actually abated. And so there's two things that we're worried about. Right? We're worried about the Delta variant, and there's domestic concern that it will further dwindle the pool of workers, which will cause some inflationary pressure on wages as businesses compete for a dwindling pool of workers. But the primary concern is more global. And we're starting to see this manifest itself with the companies. Many a company was reporting guidance despite spectacular beats that was either in line or warning for margin pressure. And that's because they don't know what this looks like and how it's going to affect their supply chains. The countries that we're sourcing from are much less farther up the vaccine curve than we are. We're around 50%. Australia and New Zealand's at 11, Taiwan's at 4.9, Thailand's at 0.5%. And so the question becomes, are the supply chains going to be impacted more acutely and for longer than we thought? And if that's the case, it makes having the courage to guide higher or to put up ambitious numbers probably not prudent.
It's fair to say, Greg, that this is a time period where if you are the CEO of a company, it's almost expected that you're going to bring up things like cost pressures, supply chain constraints, and everything else, and you're actually an aberration if you don't. But what does that mean then for the investment thesis if there is that lack of clarity out there? Is this all just a bet? Is it just a bet and not investing if you don't know what the future is going to look like?
Well, let's put the variant aside for a second. My view 2 months ago was that we were going to see spectacular second quarter and third quarter results, and I think that that's intact. When I looked at consensus across the sectors, consensus was forecasting earnings power that was 60 and 70% of the pre-pandemic levels. And so consensus is still light. I think it still underestimates the true earnings powers of the companies. Now, that said, if you're a CEO, like you said, there is really little to no motivation, little to no reward to forecasting your true earnings power, particularly when you just don't have the visibility into what your labor costs are going to be and what your input costs are going to be. And lastly, whether or not you're going to be able to pass that pricing on to the consumer.
So if that's the case, what do you buy? Do you just go back to the mega cap stocks that have kind of been doing all of the heavy lifting? Is it companies like Amazon or Walmart or Target or everybody else that's done relatively well during the pandemic?
Right. There are lots of good stories that I like. So you're indicating one, some of these tech names, the hesitancy around these names, not only on valuation, but the question was, the results we saw last year, was that a COVID-related bump or a COVID pull forward that wouldn't be replicated or would be hard to beat this year? And the companies are resoundingly answering that with, this isn't short term. This wasn't transitory. We are in a digital advertising cycle. We are in an e-retail cycle. We're in a hardware cycle. And the results are showing that. Now, for some of these companies, we're going to lap tougher compares in the third quarter than we did in the second. But I think that they'll continue to demonstrate exactly what we've seen in the second quarter. For some of the companies, the question becomes, what, if any, cost pressures, because that doesn't apply to tech, what, if any, cost pressures affect consumer spending? And for that reason, I think that the value segments are attractive as well. We saw this with Domino's, we saw this with Chipotle, where we thought we'd have pizza fatigue, where we thought we'd have burrito fatigue. But at the end of the day, the inflationary pressures are hitting the mass consumer, are hitting the average American worker in ways that are really impactful and probably changing behavior.
Shepard Smith here. Thanks for watching CNBC on YouTube.